Hi everyone, I'm Chad Shoop and I'm the editor of Automatic Profits Alert. And today we're going to talk about the volatility that we've seen in the month of October. Now I'll be the first to admit that I didn't see this coming. I actually called for October to be a pretty smooth ride, and that's because we saw the correction earlier this year back in February, and then since May to October we saw a steady rise in the stock market. So I was expecting that to continue, and even though I knew that October was historically the most volatile month of the stock market. But now volatility's here. We saw the big drop on October 10th where the Dow fell over 800 points. And people are blaming everything. But I've seen a lot of headlines, though, that are pointing direction at interest rates. Even President Trump is blaming the Fed. He's saying that they're raising rates too fast. So I just want to use this video today to say, let's pull that back a little bit. Interest rates are not the issue right now. What you want to watch is inflation, and the Fed is not raising rates too fast. They're actually going at one of the slowest paces they've ever went. And when you look back at the last 3 interest rate hike cycles, and that goes back to the mid-90s, this is, at least by a multiple of 2, the slowest they have went at increasing rates in the economy. So they should be going at least twice as fast to catch up with the other rate hike cycles as far as how fast they go. So they're taking it extremely gradual, and that's just looking at interest rate hikes. Not to mention that this time around, when they had rates pinned at 0, they wanted to do more stimulus in the economy through the Federal Reserve, so they implemented quantitative easing. And that program ended in about 2014. So for almost 4 years now, the Federal Reserve has actually been trying to tighten the economy. And when you look at it from that perspective, a 4-year tightening cycle, this is by far one of the slowest paces the Federal Reserve has ever gone about tightening an economy. This is as gradual as they can possibly go. And now they've increased rates a few times, and I think they're actually about to stop because the metric that they want to watch is inflation. So they've been able to go through this. They've had several interest rate hikes now, and they want to see if it's enough to subdue inflation, because inflation is the big problem, and that's what they're worried about, and that's why they've been increasing rates over the past 2 years. Because when you look at President Trump, once he became elected, he introduced a stimulus package where they had major tax cuts, right? The consumers benefited, corporations benefited, and the overall economy is going to benefit. So that's great news. It's great for the economy, and it's going to see our economy continue to grow. And then it's also going to help put pressures on inflation to rise. So then you go to trade wars. Now we have that bubbling up. And trade wars or tariffs, they also increase the price here in America. So that's inflationary pressures, because inflation is just a measure of price. So if prices go up, inflation goes up. And with trade wars, it's got pressure to push inflation up as well. And then you come to our unemployment rate, which is we're practically at full employment right now. So in order for people to hire new people or to maintain their good employees that they want to keep, they're going to have to raise wages a little bit, and that's going to put pressure on inflation as well. So you have these major areas in the market right now that are helping put pressure on inflation, and the Fed is trying to stay ahead of that by getting a few rate hikes in. So let's not blame interest rates right now. I think they've been very gradual. I think they're at a very nice level here. I think it's a nice balance. It's not really going to spook the market. This is not why we're seeing the pullbacks in the market. It's just these are normal pullbacks that you see on any bull market, and it's very healthy to see profits being taken, a few investors shaken out of the market, and then investors come and rush and buy back in and lift the market to new highs. So right now I think that's exactly what we're seeing, because there's enough worries going on in the world for you to take money off the table. We have the Saudi Arabia issues bubbling up right now. Emerging markets continue to get hammered. China's economy looks pretty weak. The U.S. is doing great, but then you have trade wars. So that's a global issue that people are looking at. The oil market's very volatile. So there's a lot of areas in the market that people can look at and say, yeah, that concerns me. Let's take a little bit of money off the table. And interest rates is one, and then inflation's one. But in the end, I think we're at least 2 years away from a big issue in the stock market, from a big issue like a stock market crash or going into a recession. I think we have at least another 2 years, and I think you're going to see that play out. The market's going to turn and go higher from here. We're going to hit new highs. Probably by the end of the year, the S&P 500 will be back at all-time highs. So we're going to see a quick turnaround from this correction, and now's a great time to jump in. And if you want to keep your eye on something, it's not interest rates, but you want to watch inflation and see how that does, because the Fed is going to react to the inflation data. And if that starts to go up, then the Fed's going to have to react even faster, and that's when the rates are going to get out of hand. So in the meantime, just watch inflation and use these pullbacks, though, over the next 2 years to put more capital to work in the market and to buy on the dips. So use that as a strategy going forward to make money as this bull market continues to grow. Well, that's all for my video today. I hope you enjoyed it. If you liked it, subscribe to our page and continue following us for more great insights. Until next time, this is Chad Shoop with Automatic Profits Alert.